The current trading session has SoFi Technologies, SoFi, changing hands at exactly $29.49 per share, marking a decline of approximately 0.79% on the intraday chart as we move through this Monday morning session on December 1, 2025. The market is currently open, and we are seeing a volume of over 19 million shares traded already, indicating significant hand changing in the opening hours. When you look at the price action right now, the immediate expectation from the retail gallery is that the momentum has stalled. You see red on the screen, you see a stock that has rallied significantly year to date, up over 100% in 2025, and the natural human instinct is to assume the party is over. The expectation is that gravity is finally taking hold of a high-flying fintech that has perhaps run too far, too fast. But the reality of what is happening on the order books today is entirely different. What looks like a stall to the untrained eye is actually a consolidation phase, where institutional capital is quietly absorbing the profit-taking from retail traders who are nervous about preserving their gains. While the average investor sees a red day and worries about a correction, the deeper reality is that SoFi is pivoting from a speculative growth trade into a foundational financial asset, a transition that often shakes out the weak hands before the next leg up. This tension between the fear of a crash and the reality of institutional accumulation is where the real opportunity lies, and that is what we need to unpack today. When we talk about SoFi, we are not just talking about another bank or a simple app on your phone. The narrative expectation is that this is a competitor to Robinhood stock trading, or just a digital version of Fidelity investments. People assume it is just another place to buy Tesla stock or Apple stock and maybe hold a checking account. But that view is dangerously surface level. The reality is that SoFi has quietly engineered one of the most comprehensive vertical integrations in modern finance, effectively building the AWS of Fintech, while everyone else was focused on just being a user interface. If you look at the price friction today, sitting just under that psychological $30 level, it represents a battleground. You have traders who bought in the teens earlier this year looking to cash out, creating supply. But on the bid side, you have heavy institutional volume stepping in, recognizing that the company's recent Q3 earnings, showing 38% revenue growth and record net income, were not a fluke, but a confirmation of operating leverage that legacy banks cannot match. This disconnect between the sell the news crowd and the buy the growth institutions is creating the very volatility we are seeing on the screen right now at $29.49. Let's analyze the recent movement with some granularity. The stock has been volatile in November and leading into December, oscillating between $28 and $32. This isn't random noise, it is price discovery in its purest form. The recent news that SoFi Bank became the first nationally chartered bank to launch crypto trading for consumers sent shockwaves through the sector. The expectation was that regulation would stifle this kind of innovation for a chartered bank. The reality was that SoFi navigated the regulatory maze better than anyone anticipated, effectively beating Robinhood crypto and Interactive Brokers' trading capabilities in a regulated banking environment. This development is massive because it signals that the regulatory moat, which was supposed to be a hindrance, is actually becoming SoFi's sword. When you see the stock now nearly 1% today, you have to ask yourself, is the market discounting this news, or is it simply digesting the implications of a bank that can offer NVIDIA stock trading, crypto access, and high-yield savings all under one insured roof? The volume patterns suggest the latter. We are seeing sustained buying pressure on dips, which is a classic signature of accumulation. To understand why the stock is trading at these levels, we have to strip away the marketing and look at the business model mechanics. Most people think of SoFi Investing or SoFi Active Investing as the core product. And while the SoFi trading platform is robust, allowing for self-investing and online investment with ease, the real engine here is the financial services productivity loop strategy. This is where the comparison to Schwab Intelligent Portfolios or Fidelity Wealth Management gets interesting. Traditional investment help or investing sites often struggle with cross-selling. You might have a Fidelity brokerage account, but do you have their credit card? Do you have their mortgage? Probably not. You might use the Robinhood app for Robinhood fractional shares, but do you use Robinhood Cash Management for your direct deposit? Maybe, but the attach rate is lower. SoFi's reality is that they have cracked the code on cross-selling. They acquire a customer through a low-cost channel, maybe a student loan or a SoFi Invest account, and then aggressively move them into high-margin lending products. The data from their recent quarter proves this flywheel is spinning faster than ever, with products per member increasing. This lowers their customer acquisition cost significantly compared to a standalone individual brokerage or a legacy bank that has to pay for physical branches. However, the most misunderstood part of SoFi, and the part that likely justifies a valuation premium over peers like SoFi versus Robinhood or SoFi versus Schwab, is the technology platform segment, primarily Galileo and Technisys. This is the B2B side of the business. While you are debating whether to buy SoFi stocks or SoFi ETFs, SoFi is busy powering the back-end infrastructure for other fintechs and neobanks. Think of it this way. When you engage in online investing or use various investing sites, there is a decent chance SoFi's technology is running the ledger in the background. This turns SoFi into a technology infrastructure play, not just a consumer finance play. The market expectation is often valuing SoFi purely on its loan book, like a traditional bank, which is why you see the PE ratio scrutinized so heavily. But the reality is that a significant chunk of their future value is derived from recurring technology revenue, which deserves a much higher multiple, similar to how Tesla stock is often valued as a tech company rather than just a car company. This mispricing is what creates the long-term alpha potential that keeps institutional investors interested despite the high headline valuation multiples. Let's pause for a second on the competitive landscape, because this is where the SoFi investing narrative often gets muddied. You have giants like Fidelity Investments, offering everything from Fidelity ETFs and Fidelity mutual funds to Fidelity IRAs. Fidelity has the trust and the trillions in assets. Then you have Interactive Brokers, known for the Interactive Brokers trading platform and low Interactive Brokers fees. Interactive Brokers account holders are often looking for pure execution. Then you have SoFi. SoFi sits in a unique middle ground. It offers the sleek, gamified user interface of the Robinhood app, appealing to the generation that grew up on mobile, but it backs it with the product breadth of a Fidelity wealth management offering. It's not as complex as the Interactive Brokers stock trading interface, which can be intimidating for new investors, but it's far more comprehensive than just a simple trading app. SoFi Robo-Advisor services compete directly with Schwab Intelligent Portfolios and SoFi Invest automated options, but they integrate it with lending. This super app strategy is often talked about, but SoFi is one of the few actually executing it. They are stealing share from both the legacy incumbents and the niche fintechs. Now, I want to hear from you. The debate on valuation is heated right now. Comment below how many shares of SoFi you currently hold, or if you are waiting for a pullback to a specific price level like $25 or $27 before you start an online investment position. Are you in the camp that thinks this is a $50 stock by 2026? Or do you think the regulation risks are too high? Let me know in the comments. Moving back to the analysis, we need to address the elephant in the room, the lending environment. For a long time, the expectation was that high interest rates would crush SoFi's student loan and personal loan business. The reality, however, has been a masterclass in balance sheet management. Unlike some competitors who got caught with underwater assets, SoFi has maintained high credit quality. Their borrowers have high FICO scores and high incomes. This demographic resilience is why, even as we see economic data fluctuating, SoFi's default rates have remained manageable. The market was pricing in a disaster scenario for their loan book that simply never materialized. Now, as we look at the macro environment in late 2025 with rates stabilizing or potentially coming down, the refinancing boom could be the next major catalyst. If rates drop, millions of Americans will look to refinance debt. Who is positioned best to